And good morning once again to all of our options traders. Well, anybody who's followed the channel for any time at all knows that every once in a while I will post a video on technical analysis. And while I primarily try to focus on options and strategies, technical analysis can play an important role in a lot of cases. And that's because many times traders are trading shorter term options. And when you're trading shorter term, it's pretty much more at the noise level. And that's where technical analysis can certainly play a helpful role. Now, in the world of technical analysis, when we're looking at a candlestick chart, there are a couple of terms you need to know, and that is inside versus outside days. What are these things? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. Let's start with an inside day. This is a two candle pattern, which simply means we are looking at two candles. Let's say that we're looking at yesterday's candle and today's. The second candle's high and low will sit inside the previous day's candle, inside that entire body. And what this shows is that the volatility has contracted and that it could be a consolidation pattern. Now, in most cases, this is seen as a continuation pattern. It's not seen necessarily as a negative, like a lot of traders think. So, for example, let's say that we see this as a 2-day pattern. Yesterday, we got this nice big green candle, and then today we get this smaller bodied red candle. Now, in this instance, notice that the red body sits inside the green body from yesterday, and so do the high and low. That's these black lines extending upwards and downwards. Those are called shadows. Some traders call them wicks. But in this instance, the shadows and the candle body sit inside yesterday's body. That is definitely an inside day. But we could also see this, where the shadows maybe extend outside of the body, but they are still inside of yesterday's shadows. That is still an inside day. So what we're really looking at are yesterday's highs and lows. And as long as today's candle, whether it's the body and or the shadows, as long as they sit inside of yesterday's highs and lows, then it is considered an inside day. So what exactly does this show? Well, if we get a series of inside days, this is where it gets a little technical, a little confusing. It may show a sign of a breakout, but it could also be a sign of a breakdown, meaning that the stock is about to go on a rally, that would be the breakout, or to fall, in which case we would normally call that a breakdown. Technically speaking, both of them are called breakouts, but to be clear, I usually designate breakout to mean to the upside and breakdown to the downside. Now, in most cases, you will lean towards a breakout if it is a long consolidation. Stock hasn't fallen, just looks like a lot of traders are swapping places. So the previous traders who might have some nice gains are now selling to a new group of traders. We get this long consolidation period. In that case, we might lean toward it being a breakout. But there could be another reason. It could be a breakdown just because price pressure is falling. We don't have quite the numbers of buyers out there, or maybe the buyers aren't willing to put as much pressure onto that price, not willing to bid as high for it. So this is, again, where it gets confusing. There's not a real clear-cut way to say whether it's the sign of a breakout or a breakdown. And in these cases, traders must use other forms of technical analysis to try to lean towards which side it might be. So a series of inside days would look something like this. We have our first candle, the body and the shadows extending out here, pretty good range. And then the next days sat inside. The next days sat inside of those highs and lows. So did the next. Let's say if this is today's candle, also sits inside. This is a series of inside days, and again, could be a consolidation right before a rally, but it could also be the sign of an impending breakdown. So the main thing is to just be aware whenever you get an inside day, and especially if you get a series of inside days. Now, as a little technical note, many of you might recognize these first two candles. If they appeared at the top of a big run, that's called a harami, which would be a bearish sign, and this is why. We had this nice big run We have this very large green candle yesterday, and then we get this inside candle. And so if these two appear after a very large run up, then that would definitely be more of a sign of a breakdown. Okay, so that's the basics of an inside day. What's an outside day? Well, you probably figured it out. It's just the opposite. It means that the second candle's high and low will sit outside of the previous day's candle. Now, the trick here is to understand that the high and low must sit outside of the previous day's candle. However, we need the second candle's body to also lie outside the previous day's body. And what this shows is that volatility has increased. And of course, just like before, it might be the sign of a continuation pattern, but it could also be the sign of a reversal. So for example, let's say that we get this on our daily chart. Here's yesterday's candle, and then we get today's. So notice that today's shadows sit above and below yesterday's shadows. They sit outside of yesterday's high and low range. So that's the first thing we can see that would at least qualify this as an outside day, but we need more than that. We have to see that today's body also sits outside of yesterday's body. So that's just telling us that today's open and close, remember this colored part of the candle is the body. And for a green candle, the bottom is the open, the top is the close. So the range for the open and close today was greater than the range for the open and close yesterday. So that's a clear sign that there was more price action or more volatility today than yesterday. So we've got 2 for 2 checks, so that is definitely an outside day. And in a case like this, most of the time it's going to be viewed as a continuation pattern. And that's because we got a green candle yesterday and a green candle today. Notice to get a green candle, we actually gapped down. This would be the opening. This would be the close. So yeah, we might have gotten some price pressure here off the opening bell, but through the day we rallied. And that's why it's wrong when you hear traders say that this is an engulfing pattern and therefore bearish. Well, this is green on green. You would have to lean far more towards bullish or a continuation pattern. Now, what if it were a red candle? Now this is more of a sign of a reversal, especially if we had a very big run coming up into this. And that's because we've got today's highs and lows are above and below yesterday's, and today's body also sits outside of yesterday's body. This entire candle's body and the shadows will sit outside of yesterday's. So again, that's normally a sign of a reversal. So in this case, this would be more like an engulfing pattern, a true engulfing. If we had a nice big run up coming into this, we get a green candle yesterday, everything looks bullish. Today we gap up, top of the red, but throughout the day something changed and the market reversed. So we got an outside day switching from green to red. If you see this, you would have to lean toward it being a reversal. Now, just to be clear, this is not an outside day. Even though we have the shadows from today sitting outside of yesterday's shadows, or the highs and lows today are in a greater range than they were yesterday, notice that today's body does not sit outside of yesterday's. So this is one where a lot of traders get confused and they think that just because these shadows sit outside of yesterday's that it's an outside day. We also need the candle body to sit outside of yesterday's. So that is not an outside day. So what do you want to take from inside and outside days? Well, like all forms of technical analysis, they're just clues. They give additional insights into continuations or reversals. They are not crystal balls. And that means they should be used with other forms of technical analysis. That is pretty much true for any form of technical analysis, technical indicator, whatever it is you're looking at. But if you happen to see that you also have inside or outside days, it can be an additional clue. And these are always important tools for technical traders. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.